Morning, everyone. My name is Tanmay Jain, and today, me and my teammate will share some key learnings from the book Unusual Billionaire. This presentation has created by the seven members. Each member has created a slide which shows what they have learned, the key learnings. So, moving toward the next slide, before moving to the index, let's know about the author. So, the author of The Unusual Billionaire is Sir Saurabh Mukherjee. He is the founder and chief investment officer of Marcellus Investment. He is also known for his deep investing and capital allocation strategy. He is the author of multiple influential investing books, including The Unusual Billionaire. So, moving to the index slide, this shows the key takeaways that we have learned and present in this slide. So, first is greatness. This is what the authors define what is the exponential companies. Then we move towards the coffee can portfolio, where we study that what is coffee can portfolio and what is the coffee can portfolio of today. And then we will see about opportunity, management decision, innovation, architecture, and many more. So moving towards the first slide. First is quantifying the greatness. According to author, the business is not great which use the brand recall, innovation, market capitalization, etc. According to the author, this is based on the two things. Means this their criteria is based on the two things. First is manufacturing and non-financial companies, and second is banking and financial companies. In manufacturing and non-financial companies, the ROC should be more than 15%, and the sales growth should be more than 10%. And for banking and financial services, the ROE should be more than 15%, and loan growth should be more than 10%. And all the companies have the market capitalization of more than 100 crores. So this shows how the business uses its capital allocation. So moving towards the next slide, that is coffee can portfolio. So what is coffee can portfolio? Coffee can portfolio means that you buy the high quality stocks and then forgot it to so that the compounding will work. So according to the author, the previous coffee can portfolio that is made by the author is the 100 crore market capitalization, 15% ROCE, and sales growth of more than 10%. But today's coffee can portfolio is has changed because I have taken 1,000 crore market capitalization, 15% ROCE, and 10% sales growth. According to this criteria, only 153 companies out of 5,200 listed companies has passed this criteria. Means the selection and the company is rare. So moving toward the next slide that is presented by the Google.
Thank you, Dhanmai, for giving me a chance to speak on business opportunities. Let's talk about business opportunities. This book shows some of India's most successful companies like Asian Paints, Berger Paints, Marico, Page Industries, Axis Bank, HDFC Bank, and so on. They are not lucky businesses. They become billion-dollar companies by following a disciplined, smart, and long-term strategy. Let's discuss some opportunities. The first point is opportunity to build a strong brand. Companies like Asian Paints and Marico did not sell just products. They built trust in customers' mind. When people think of paints, they think of Asian Paints. When people think of oil, they think of Parachute. There are three big advantages. Customer stays loyal, company can charge higher prices, and it is difficult to enter for new competitors in the market. And the opportunity for the business to get to build a strong brand is if you build strong brand, you with your customer trust, you 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 are going to earn higher profit for decades. Let's talk about second points. Opportunity to build a good distribution network. Company like Asian Paints has one of the largest and fastest distribution system. Their paints reaches even the smallest town faster than competitors. The company that reaches the better wins the market, and the opportunity to get a business to build a distribution network is to build a system that makes your product easily available, faster, and cheaper than others. Let's talk about third point, opportunity, consistency, and success. These companies focuses heavily on discipline, system, and processes. They does not depend on one superstar CEO. They build strong management system, good hirings, and clear decision makings. And the last and final point I would like to discuss with you is opportunity in long-term thinking. Most people think for short term, but companies think for long term for companies' growth. They invest in technology, quality, customer experience, and employment training. The final conclusion I would like to share with you that whether you are entrepreneur, investor, or a student, this book shows that consistent excellence creates extraordinary success. Now it's time to give a chance to speak on management strategies to Paswasa.
Thank you, Yugal. I am Pashwa Shah. I will talk about management decisions. When we look at a company that has survived many business cycles, intense competition, and constant change, one thing becomes very clear. Long-term success does not come from speed or aggression. It comes from quality of management decision made constantly over time. Across Asian Paint, Berger Paint, Marico, Page Industries, Axis Bank, HDFC Bank, and Astral. Success was not built on bold risk, but on calm, thoughtful decision by the management. One strong management decision come across this company is the choice to build system instead of taking the shortcut for the company. Asian Paint understood this very clearly. Management realized that the paint is not something customer actively search for, it is sold through availability. Instead of competing only on price or capacity, they invested heavily in logistics, demand planning, and the dealer services. As a result, whenever a painter or dealer needs stock urgently, they only think about Asian Paint as they have that type of reputation. And because they deliver faster than anyone else and create long-term trust and loyalty with the customers. A similar approach was also seen in HDFC Bank, where they did not chase rapid loan growth. It first strong built system for the credit checks, data discipline, and risk control, and only then it decided to expand. In both the cases, which we saw right now, be it HDFC Bank or Asian Paint, both were showing that how business are run and not just how fast it grows. Another clear pattern in the ability of the management decision, which is one of the hardest, is to say no. Berger Paint demonstrated this the best because everywhere they were management focused on religious with strong dealer relationship, reduced pressure on capital and execution with ensuring steady growth. Page Industry also followed the same with a similar path, repeatedly saying no to unrelated business, fashion-led customers, and discount-driven growth. These choices protect brand quality and repeat demand. Saying no may be conservative, but from the perspective of management decision, it shows confidence and clarity. Moving on, risk control is another area where good management stands out. Axis Bank is a clear example of that. When asset quality issue emerged, management took a difficult decision to recognize bad loans openly instead of dealing the problems. While this hurt the short-term profit of the company, it helped build a reputed and a regular with the investors and the regulators. At the same time, the bank reduced risky corporate lending altogether and shifted their motto from to safe retail and secured loans, which was also shown by HDFC Bank, but it was much earlier as they were avoiding risk altogether. And even when the competitors were repeating very fast growth, this decision highlights that protecting the downside is more important than chasing the short-term gains. Some of the toughest decisions arise during the moments of the temptation of the company. Marico faced such a moment when it received an attractive offer from HUL. Selling would have been the easiest and most benefit decision for the Marico. But instead, management chose independent and long-term valuation creation of the company. During the price war, Marico remained calm, improved its product quality, and expanded the distribution and strengthened the brand trust of the company. Over the time, Marico also professionalized leadership, separating ownership from the management and demerging Kaya to sharpen the focus for the company, and also slowed the acquisition rate when returns were very unattractive for the company. This decision reflects patience and long-term thinking by the management. Knowing when to exit is as important as knowing when to enter. Astral shows this clearly by as management entered industrial pipes in the starting phase, but quickly realized that competition was very high and pricing power was very weak. Instead of continuing due to ego or past investment, they exited the segment and refocused on plumbing products. Though it was very difficult, this decision helped build a strong and profitable business in the current market and in the near future. Berger Paint also showed similar discipline by avoiding excess capacity and discount-led volume growth. This decision showed a realistic and flexible decision made by the management. Across all these companies, one common theme is focused growth with control. Asian Paint entered new categories only when the dealer network could be used efficiently. Page Industries expanded slowly only when the supply chain were also used very effectively. Axis Bank simplified its loan book to reduce the risk. HDFC Bank expanded retail lending only when after building sufficient data confidence. In every case, management waited until the business was ready and very efficient to a utmost point, ensuring that growth never weakened control of the company. When we connect all the example, one message stands out very clearly. This company did not succeed by moving fast or taking very high risk. They succeeded through repeated disciplined management decision, building system, saying no, controlling risk, and exiting early when required, and protecting long-term value even at the cost of short-term profits and the results. This is what defines the strong management and separates the enduring business from the temporary winners. So now I would like to pass it to my colleague Mr. Shivanand, who will talk about IBS framework.
So hey everyone, I am Sivanand Marjan. So let us understand how Saurabh Mukherjee sir explained long-term business success to our IBS framework, where companies want through innovation, branding, architecture, and strategic assets. So I will be focusing on the innovation pillar of IBS framework. So innovation can be divided into various categories. So first, starting with the first one, that is product innovation, where a company focused on solving customer problems and supply side challenges. So for example, Marito, which innovated various products and since it was facing raw material uncertainty, it launched Saffola plans, which increases its market and reduces dependence on a single product. Product innovation is not only limited to physical goods. In banking sector also, HDFC innovated did credit innovations like 10-second instant loans and loan against securities. Now let's turn to packaging and branding. This is mainly done to increase convenience and brand reportability. So for example, take the example of Marico, which completely changed its packaging material of oil from tin containers to plastic bottle, which eases its handling. Another example is that Zotis started stitching its brand name on waistband, which increased the brand visibility. Now let's come to technology enablement. Technology enables speed and scale. So in this case, let's take an example of the Berger pens, which launched dealer tinting machine, which reduced the tinting time for pens, and it was very beneficial for the dealers as they have to store low inventory and through which they could produce large variety of pens for their customers. Automation was done on a large scale in banking sector also, like digital onboarding and automated banking, which reduced the account opening process and times from days to single minutes. Can you go on next slide? So process innovation focused on speed, predictability, and efficiency. So let's take the same example of Berger pens, which reduce the tinting time from 5 to 6 days to 4 hours. Another classic example in this case is HDFC Bank, which replaced manual payment and settlement cycles to real-time electronic payments, which reduced their operational risk and freed up their working capital across their supply chain. Financial Now let's come to financial business model innovation. Asian Paints started giving 3.5% discount to the dealers who made their payments on timely, which improved their working capital cycle. Another example in this case is that Axis Bank started segmented servicing model where they served their low-cost customers via call centers and they were dedicated relationship manager for a premium customers. This overall automated process improved cash flows and reduced risk. Last not but the least, distribution and scale. Like any other FMCG company, Marico also pushed their dealers to achieve their targets and they rewarded them through foreign travel incentives. So the next slide will be explained by Dave.
Thanks, Shivanand. All right, I'm Dheemanjani and I will be talking about architecture. So, here, architecture isn't some kind of construction or building. Here, architecture means that how well a business is able to build its system in such a manner that good decisions can be repeated again and again. So, the author has tried to convey us that strategies alone aren't enough. That is, many companies are able to build good strategies, but there are few of them who are able to repeat that strategies again and again. With that, I would like to grab your attention towards my patterns, which I have created and I have thought that are common within the companies. So, the first pattern is process driven decision making. Here, important decisions are guided through predefined statements or systems rather than individual judgments. For example, Asian Paints, who have emphasized heavily on their supply chain managements, which have built dealer loyalty as well as fast delivery. Now, I would like to move on to the next pattern, which is incentive alignments. Here, both employees as well as partners are rewarded on the long term basis rather than short term wins. For instance, Page Industries have designed their incentives in such a manner that employees get benefited in the long term rather than short term. So let's move on to the next pattern, which is decentralized execution with control. Here, frontline managers are given enough power and autonomy to make their own decisions. This helps the firm in taking quick decisions, which are helpful for the firms who are already in FMCG or consumer-based industries. For example, Marico, whose brand managers act as an owners. So let's move on to the next pattern, which is long-term relationships. So companies like Asian Paints and Astral Polys have invested into a long-term relationships with the dealers and distributors. This has proved to be a competitive advantage in the near future. So let's move on to the next and the last pattern, which is conservative risk architecture. Here, growth is pursued carefully with the focus of resilience and survival. These mindsets have helped the firm to become stable even during the economic downturns. So, one thing is clear that these companies, although being in different industries, have focused on building a great architecture. With this, I would like to conclude my slide. Thank you everybody. Now, I would like to pass the torch to Jinal Kothari.
Thank you. Thank you, Jay. Hello, everyone. I am Jinal Kothari. So this slide is on strategic assets. Strategic assets are the long-term strengths that competitors cannot replicate easily. In the book, these companies did not win by short-term tactics, but patiently building assets that created strong entry value. First, Pan-India supply chain and distribution network are major strategic assets. For example, Asian Paints built one of the deep distribution networks across India, reaching even small towns and villages. This ensured faster delivery, better availability, and deep dealer relationship. Second, manufacturing and production footprints also plays a critical role. Companies like Berger Paints and Page Industries invested early in multiple manufacturing locations. This ensured cost efficiency, capacity control, and operational reliability. This brings us to our third point, physical and financial infrastructure, which is clearly visible in Axis Bank. Axis Bank built strong brand network, ATM presence, and deposit base. This infrastructure ensured lower funding cost and improved customer access. Another key asset is strategic global partnership. Marico, for instance, leveraged international alliances for for personal care and food categories. Lastly, these companies don't operate assets in isolation. The ecosystem-based advantage where supply chain, distribution, brand, and relationship reinforce each other, which creates strong market barrier. This is the reasons this business dominates the sectors for decades and not just for years. This brings us to our next slide, capital allocation strategy. Capital allocation is where strategy meets discipline. In the book, the biggest differentiation is not how much these companies had, but how carefully they deployed it. First, they followed disciplined deployment of capital, which means, example, Asian Paints invested only when long-term returns were clearly visible, mainly in manufacturing, logistics, and technological areas. Second, companies maintain strong focus on core businesses. Page Industry, the licensee of Jockey, avoided unrelated diversification and expansion and reinvested cash in its own brand. Third, these companies maintained high return threshold, which means investment were approved only if they met the strict ROC criteria. Marico, for instance, walks away from acquisitions and expansions that do not meet ROC criteria. Another important aspect is conservative balance sheet. Axis Bank, especially post-stress cycle, focused on maintaining capital adequacy and low leverage to survive economic downturns. Lastly, these companies followed counter-cyclical investing and shareholder value orientation, which means they invested aggressively during economic downturns and returned surplus cash to shareholders through dividends or buyback if reinvestment opportunities are limited. Overall, this disciplined capital allocation strategy ensured long-term wealth rather than short-term profits. Now, I would like to invite Nandini to present next slide.
Thank you, Jinal. Hello, everyone. I am Nandini Maskara, and I'll be explaining the challenges impacting the company's profitability. So, the aggressive competition. There are multiple players in the market who are chasing the same demand. For example, the Marico, HDFC Bank, and Page Industries having an aggressive competition from the competitors like HUL, the foreign banks, and the Rupa. Price wars. Sectors like commodity and basic goods, competition limits a firm's ability to raise prices. Asian Paints, for example, operates under a low differentiation product sector where the trade margins are inherently low. Competitive urban market. So as we have seen how the Asian Paints, the Berger Paints find it difficult to launch their decorative paint in tier 1 cities. Professionalization, a shift from promoter-centric to institutional process-driven management. So, for example, how the Marico changed its family business to a professional-driven management. Also, the Berger facing professionalization challenges due to the frequent change in its promoters. Highly fragmented. So, there is no single player who has dominant market share. Also, the recognition, the brand recall, trust, and credibility in a crowded market where the customers struggle to distinguish one player from another. For an example, the Astral Poly had to sell its product in loss because of the market being skeptical. Also, the banks finding it difficult to build the trust because of the already established banks. Now, let's take a look on the key takeaways from the book. So, the long-term wealth creation is not driven by luck or aggressive expansion, but by disciplined execution, superior capital allocation, and the ability to build durable competitive advantage. Also, the book, The Unusual Billionaire, shows us that the companies that focus mainly on the core business and reinvest its capital with the higher return always outperform its competitor and survive in a competitive market. Sustainable growth, not the short-term profit, is the key hallmark for the exceptional businesses. The true winner is not the one that grow fast, but the one that compound consistently. So with this, we come to the conclusion of the presentation where all the members have shown the hard work. Thank you for your time and the attention.